Hey everyone, I'm Ryan Brooks. Since October started, the S&P 500's been flat. It looks calm, but big money's quietly moving. This isn't noise. It's Wall Street setting up for the next big move.
According to recent ETF flow data, over the last 2 weeks we've seen a rotation out of high-growth tech and small caps, and steady inflows into defensive and cash flow-heavy sectors, namely healthcare, financials, and semiconductors. At the same time, option activity from hedge funds and asset managers shows increased positioning in stocks with strong earnings visibility.
In other words, the market may look quiet, but under the surface, the big players are quietly rebuilding their portfolios, rotating away from hype and back into fundamentals. Let's look at what that rotation actually looks like.
First, in the healthcare space, institutional filings show continued accumulation in IMSH's Health HIMS, a digital care platform that just turned profitable and post 89% year-over-year revenue growth. Funds are betting on expanding margins and recurring revenue models, especially as the sector becomes a defensive play against macro volatility. Second, SOFI Technologies SOFI, one of the fastest-growing digital banks, has seen new institutional inflows as traditional banks face margin pressure. Member growth has tripled since 2021, and EBITDA margins are approaching 30%. Funds view SOFI as a structural growth story within the fintech space, especially as lending demand stabilizes and retail deposits continue to rise. Third, in the semiconductor sector, capital is moving toward Taiwan Semiconductor TSMC, the global leader in chip manufacturing, now controlling over 90% of advanced chip production. Despite geopolitical risks, hedge funds increased exposure in Q3 as margins hit 48%, and analysts project 20% earnings growth over the next 2 years. Finally, outside the U.S., investors are rotating into Mercado Libre MELI, Latin America's e-commerce and payments giant. Often described as the region's Amazon plus PayPal combination, institutional data shows steady inflows as revenue grew from $2 billion pre-pandemic to $24 billion over the past year. Funds see it as an emerging market growth hedge amid slowing U.S. momentum.
Put these signals together, and the story's clear. Wall Street isn't leaving, it's rotating. Money is moving out of high-risk tech and into companies with profits, strong cash flow, and solid value.
Data from 13F filings and CFTC positioning confirms that trend. Institutional long exposure to cyclical growth has dropped to a 6-month low, while net longs in healthcare and industrials just hit a quarterly high. At the same time, the VIX remains elevated above 20, suggesting investors are hedging volatility but staying in the market.
So here's the key takeaway. The quiet phase of this market might be setting up the next big shift. Follow the money, not the noise. Watch where institutions are moving, because by the time the headlines catch up, the trade is already done. Let me know what you think in the comments. Is this rotation a defensive pause, or the start of a new leadership cycle? Don't forget to like, subscribe, and I'll see you next time as we track where Wall Street's money is heading next.